All right. Hello, everyone. We are at the top of the hour, so I want to be respectful of all of y'all's time. So excited to have this webinar this month. Happy Wednesday and happy 1st of October. If you're anything like me, you are very excited for fall and the cooler temperatures. I get very excited this time of year, so hopefully you're excited as well. But I'm excited for this presentation we're going to go over today. Most of you should know who we are by this point, but if there is anyone who is new on the webinar this month, just wanted to start with a quick introduction of who we are at GBS Retire, what our role is, and how we can be a resource to you in a number of different capacities. So we're GBS Retire, which falls under the GBS Benefits and also the Levitt Group umbrella. You will likely, if you aren't directly affiliated with GBS Retire, tied in through GBS Benefits or the Levitt Group through your employer benefits. And we at GBS Retire are almost exclusively on retirement and financial planning. So all we do day in and day out, myself and Chad, mostly doing individual meetings and group meetings like this, helping people prepare for retirement. So I'm very excited about this presentation today because it's kind of getting back to our roots, right? Previously, we've done webinars on estate planning, Social Security, insurance, all great topics and important for your financial plan. But this is one that kind of goes back to our roots around retirement planning, specifically involving the investments in your retirement accounts. I'm going to kind of target it a little bit more towards maybe those who are a bit closer to retirement, transitioning into retirement in the next, 5, 10, 15 years. But if you're early on in your career, hopefully, I know there will be something in here that will apply to you as well, whether you're just starting your career or whether you're retiring tomorrow, which if you are, I'm jealous and envious of you, but that's neither here nor there. So specifically, I'm the financial planner of the group here. Chad, one of our other education advisors, is on as well. His experience lies heavily in the investments as well. So for some of your questions that may come up, I may defer to him in some of those. But I'll make sure you have our contact information at the end if you want to reach out and schedule a consultation with us. Those are always free. We're always happy to meet with any of you to offer a free consultation around your retirement planning, your investment planning. We're always happy to be a resource for you in that regard. We are recording this, so we will send out this recording tomorrow in the follow-up email. So keep an eye out for that. And then if you have any questions that come up as we go, feel free to drop those in the Q&A. We'll try and get to as many as we can today. So a few different things that we're going to cover and I'll focus on today. It's all going to be about the investments in your retirement account, right? Which I know we get a lot of questions about how should I be investing? How should I be transitioning those investments from early on in my career through towards retirement? So I want to just kind of level set, make sure we're all on the same page in terms of what types of investments we'll be talking about today, making sure the terminology is all there. I want to touch on the investing glide path. When we talk about transitioning our investments, it often comes up as a glide path is what we call it from a terminology standpoint. And the three bucket strategy of investing, I want to take a good amount of time on because that's the best way, at least that I know how to mitigate some of the pitfalls and risks that we face when we get to retirement. And again, feel free to drop the questions in the Q&A as we go. So first of all, just want to take a minute to think about how we think about investing for retirement. All along the way, whether you're just starting in your career today or whether you're retiring tomorrow, we need to have goals for our investments. And initially, those goals are all just 100% risk on, trying to get as much return as we can, growth, 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 right? When we're in the accumulation phase. So when we're younger in our career, we want to be more aggressive. We want to get that accumulation as high returns as we can within reason, taking our risk tolerance into consideration. But then as we get closer to retirement, those goals start to shift a little bit. They shift from that high growth accumulation to more of a preservation and distribution type strategy. It also, in most cases, no longer becomes a set it and forget it strategy, right? When you're younger and you're just looking for growth, right, you can stick your money in an S&P index fund, right, which just tracks the US-based stock market, let it ride, set it and forget it. It's a very popular strategy, which can be very effective for those of you that are younger and have time to manage the market volatility, right? That volatility we see every year in the stock market. As you get closer to retirement, oftentimes that set it and forget it strategy is not the best. A little bit more management, a little bit more frequent rebalancing and reallocation can be very beneficial as you're more in the preservation and distribution focus. Now, there's some common pitfalls, and I want to focus on a few of them towards the end of this presentation, but there's some pitfalls that you can experience if you're not properly adjusting and transitioning those investments as you go from the accumulation to preservation and distribution stages. Some of those include the sequence of return risk, which if you've never heard that before, great. I'm going to touch on that a lot here in a minute. Excessive volatility, right? We've seen that in the stock market as it goes up and down, right? If we think back to April of this year, the markets dropped 20% from their highs. That can be kind of emotional whiplash, if you will, when we're seeing that our life's work of these savings in these retirement accounts are jumping up and down, up 10% one month, down 20% the next month. In most cases, we don't want to be having that much stress around our finances in retirement. So it's a common one that we see people coming to us even after retirement say, hey, this volatility, I can't stand it. Help me structure a portfolio that'll be better for me and my risk tolerance. Tax efficiencies is another one that I won't go into today, but that's a common one around the investments and making sure that we're able to be more tax efficient in certain cases. That's mainly looking towards outside of a retirement account. So if you have more assets outside of a retirement account, you're wondering how to invest those specifically, come to us and we can focus on that more specifically at another time. But just to make sure in terms of terminology, we're all on the same page, I want to cover what is an asset class. When we say asset classes, what are we talking about? And then the major asset classes that we use within these investment portfolios. Very simply, an asset class is a group of investment that shares certain characteristics and behaviors. So when something happens in the economy, different investments within an asset class will respond very similarly. So stocks is a very common one that we all know about. If you own a stock, you are owning ownership in a company. So if I buy a share of Apple, I actually have a percentage of the company Apple that I am owning. And then as Apple increases or decreases in value, the value of my share also increases or decreases. So stocks traditionally are the high risk, high return strategy that we often look to for people who are younger in their career and have that time to invest. For the most part, 90 to 100% of your portfolio should be in stocks when you're in that accumulation phase, because over the long term, that's where most of the growth is found within these investments. Another asset class that is common are bonds. And you've probably heard the words bonds or fixed income. They're a little bit safer than stocks. Therefore, we expect a slightly lower return on those investments. And bonds are simply a loan that you make to a corporation. So if you actually have a bond, you're giving a corporation or government, in the example of government bonds, some money, and they are promising you an interest payment. And then at the end of the term, when the bond matures, they're giving you your full investment back. And that's why bonds are a little bit safer. Because if you hold it to maturity, as long as the organization doesn't go out of business or go under, then they will give you your full investment back. So stocks and bonds are the most common asset classes when it comes to retirement investments in specifically retirement accounts. But we also have cash as an asset class. That is actually, if you think about it, an investment. And you want to be very careful with that because cash often does not provide the returns to keep up with inflation. And so there's that common phrase that even not making a decision is a decision in itself. And that can definitely apply towards keeping too much money in cash. Other asset classes include commodities, which gold, silver, precious metals would fall under that category, as well as farmland, for example. Alternatives can include real estate, collectibles, private investments, structured notes, crypto. I put a question mark there because some people argue that cryptocurrencies or digital assets are a separate asset class, which they very well could be at this point. But asset classes are essentially groups of investments that share those same characteristics and behaviors. And that's important because that's what brings in the diversification principle. You've probably heard diversification, don't have all of your eggs in one basket, right? All those different sayings around how important diversification is. The reason why we want diversification is to lower our risk of having too much concentration in one asset class. So for example, with stocks, if there's something that's happening in the economy, for example, we're expecting lower growth in the US economy, then all US stocks will likely respond accordingly. Whereas in that scenario, oftentimes if the US economy is slowing, then the Federal Reserve is going to lower interest rates to encourage growth, and then bonds react favorably to that. As interest rates drop, the price of bonds goes up. And so adding different asset classes into your portfolio is that diversification principle, which lowers your risk year to year. Now, of course, you have to be careful because the more diversification you have, the less your return potential becomes as well. Now, most of us won't be actually investing in individual stocks and bonds. We invest in what's called a mutual fund. So a mutual fund is a pool of money or a collection of investments that has a fund manager. And if you go into your 401k account or your 403b account, whatever you have with your employer, and look at the investment options, you'll see different options like the Nuveen Lifecycle 2035 Target Date Fund or JP Morgan Large Cap Growth or the Fidelity 500 Index Fund. These are all mutual funds that you can invest in. And let's say I put $100 into the JP Morgan Large Cap Growth Fund. JP Morgan is the fund manager, and they're taking my $100 and diversifying it across the 1 to 200 different companies that are all large cap growth focused in that mutual fund. So it makes it easy to be investing where you don't have to analyze each individual stock that you are purchasing. You put it into that fund based on its objective, get that instant diversification within that objective of that fund, and then you're off to the races. Now, one thing to be careful about these mutual funds, for example, that JP Morgan Large Cap Growth mutual fund I mentioned, yes, it is diversified to a sense, but it is fairly concentrated in those large cap growth companies, which all respond very similarly to different economic events. And so you want to be diversifying outside of that as well, especially as you approach retirement. One thing that we see is the most common and popular within retirement investments are the target date funds. Target date funds include probably 90% of all 401k or retirement plan assets. That's trillions and trillions of dollars are in target date funds. So most of you on this call today probably have at least some money in a target date fund. And those kind of do the whole transition your investments for you, right? And so this is what we see from that glide path we see within those target date funds, where it's a glide from the more aggressive accumulation phase into the more conservative preservation and distribution phase as you get closer to retirement. Now, one thing to remember with target date funds is they're a little bit more moderate in terms of a risk return profile. So if you want to get more aggressive, you can look outside of the target date funds. If you want to get more conservative, you would look outside of the target date funds as well. Nobody's ever gotten fired for being average, right? At least in terms from an investment manager standpoint. So they're going to be a little bit more moderate. And as you get closer to retirement, you can see that glide path, how those investments shift and transition. So I like to show this because it does a good job of helping us to visualize that gradual reduction in risk as you approach retirement. Now, when you actually need to make that shift is debatable based on your risk tolerance and your goals for the money, right? For example, there may be a number of you on here that have a pension. If you have a pension, that can often serve as more of the conservative base of your portfolio. Therefore, some of your other investments can afford to be more aggressive for longer. And so you don't necessarily need to follow this as an example to the T. So really it does come down to your goals and when you plan to use the money, but this does help visualize that overall glide path we should be thinking about in transitioning our investments. I like to show this chart here because it really emphasizes where those risk zones, where the risk areas are within your retirement plan. We don't have a lot of risk early on when we're in the accumulation phase. That's why we can afford to be more aggressive, because over the long term, we have enough time to overcome the volatility in the stock market. So we can afford to be more aggressive. There's not a lot of risk there. Once we get to about 10 years away from retirement, that's where the risk starts to ramp up a little bit. And that's really, if you haven't already started to transition your investments, when you should start thinking about it. Typically 7 to 10 years out from your retirement is when you want to start adding more conservative investments into the portfolio to prevent against wild market swings right as you're retiring, right? Because what we don't want to have happen is you get to retirement, then the market drops 30%, and then you either have to work an extra year or you start taking money out of your retirement accounts when the markets are down. We don't want to do that because then we're compounding losses. Now, there's ways to get around that I'll touch on next. But immediately after retirement as well as the next 10 years of your retirement risk zone, if you want to call it that. That's because not only are investment returns important, but your spending strategy is as well. And we're not going to talk about different spending strategies here today. Reach out to us. We can talk about that with you later. But if you overspend early on in those first 10 years or you don't get the returns you're expecting, that can impact how much income you have for the rest of your retirement. And if you don't time this right and get these really 10 to 20 year periods correct, then you're running into that risk of what we call superannuation. If you don't learn anything else from this webinar today, maybe a new word of superannuation, that's the risk of running out of money before you pass away. And so that's one of the biggest risks that retirees face, is having enough money to last for their whole retirement. And properly structuring your investment portfolio and your spending strategy during this 20-year period, this significantly reduces that risk of superannuation. All right, so I mentioned sequence of return risk. This is probably one of the biggest risks of the investments and your retirement income plan. Sequence of return risk is essentially the risk that the investments go up or down immediately after you retire. So I like this chart because it does a good job of showing the different options, different paths, depending on investment returns that you get at retirement. And really the risk is if you retire and the markets drop, say 30%, and you start taking money out when the markets are down, you can see you're actually compounding your losses because you're taking your money out, and then even if the market goes back up, it's compounding from a lower base. Whereas on the flip side, if the markets go up right after you retire, then you're compounding from a higher base when the markets do recover. And so the sequence of return risk is something to consider, but there are ways to mitigate that. And that is how you target kind of that middle line where you have your plan in place, where you have the expected rate of return that you're planning to get in retirement. And with a high degree of certainty, you can target that and accomplish that so you have more of a smooth line. The biggest thing that I run into when I'm talking with retirees is the stress around their income strategy, right? It pays to have a proper income strategy so you don't have to stress about that, even if you're potentially limiting a little bit of returns over the long term. You can see something like that where it is in line with your plan can be a lot more comforting and offer that peace of mind than if you're relying on investment returns year to year to fund your retirement strategy. The best way that I know to mitigate this risk of the sequence of returns is through what we call a bucket strategy or a bucket income strategy. And this will apply to you, again, whether you're just starting out in the workforce or whether you're knocking on retirement's door tomorrow. It really comes down to earmarking when each dollar is going to be used. For example, if I know that I have $100 that I'm going to use in 6 months or 12 months or 18 months, it doesn't really benefit me to put that into an aggressive stock because that could drop 20% tomorrow and not come up until 5 years from now. And so that money needs to be in some place that's safe because it's short-term money. Something that's earmarked for 3, 4, or 5 years, I can take a little bit more risk with that. And then money that's earmarked for 7, 10 plus years, I can be a lot more aggressive with that. Over any 10-year period in the US stock market, at least, US stocks are positive at least 90% of the time, again, over any given 10-year period. So any 10-year window allows us to be a lot more aggressive with our investments. So wherever we're at, if we're looking at our investment portfolio, we should have money that is earmarked for those shorter term goals, midterm goals, and then those long-term goals. Now, specifically for retirees, or if you're close to retirement, you should have a good amount of money in cash or cash-like investments. So that's going to be your money markets, your CDs, even short-term treasury bonds that don't fluctuate very much, but provide a little bit better return. That is what's going to fund your retirement, just period, your retirement expenses. You want to keep that bucket always with roughly 18 months to 3 years, depending on your risk tolerance, worth of expenses. And that's where you pull your income from. Anything that's longer for that will fall into the moderate term bucket, where you can be a little bit more aggressive. That's where we look to more higher yield bonds or even very safe, relatively safe stocks like the blue chip value companies such as Costco, Walmart, Coca-Cola, Microsoft, those companies that we know produce dividends. They're going to be more stable than the more smaller technology companies that are more volatile. But then the long-term money, and this even applies for retirees, you should have the bulk of your money in more aggressive positions because your retirement is going to last 15, 20, in some cases 30 or even 40 years in retirement. That's a long time. So you want a good amount of your money invested aggressively for those later years. And then each year you can imagine just a little bit of money coming from each bucket into the next bucket to then fund your retirement income. Why this works to avoid this sequence of return risk is because you always have that cash on hand ready for those expenses. So regardless of what's happening in the market, you have that money volatile and continue to grow and compound like this blue line we see here. So that's one good strategy that's popular nowadays than ever before, is kind of creating that protection a little bit yourself from that risk. Another one that was more common previously, because of some increased transparency and stipulation around fees in the industry, annuities or guaranteed income, and the pension would also fall under this if you qualify for a government pension as well. But annuities can protect you from that sequence of return risk as well, because they provide that protection on the downside. The risk or downside of the annuities, like I mentioned, is they often have high fees, and you're often limited on the upside potential with these investments. So there is a cost that comes with that protection. But as we see here, right, this little last bullet point here, studies have shown correlations between guaranteed income and happiness. And I think you can understand that as well. In some cases, it can be worth paying for a little bit of protection. That guaranteed income can provide that peace of mind, which can go a long ways in retirement. So again, we don't, Chad or I personally, we don't sell annuity policies. We can put you in touch with some that do if you're looking for that. But we also see it kind of a little bit more popular to do a partial annuitization. So you have a little bit of a guaranteed floor of income. Say you have a mortgage that you want to make sure is covered 100% for the rest of your life. You can get an annuity specifically for that purpose. You know that's covered. You don't have to worry about it. Now, what I would never recommend in most cases, maybe I shouldn't say never, but is to buy an annuity early on. So if you're early on in your career, I wouldn't look to an annuity in terms of growth. Annuity is always to provide that protection and peace of mind. So the best scenario is to look to your retirement accounts, look to the individual retirement accounts. The Roth IRA as well is very efficient to grow that money much quicker. And then when you get to retirement, if you want that guaranteed income, you can then purchase an annuity at that time, which then acts like a pension. So we work with a number of school districts and cities that have very generous pensions through the Utah retirement system. And if you don't have that, sometimes we feel bad, but that's okay, because you can look to an annuity if you want that guaranteed income when you're at retirement. And so annuities are one way to avoid some of those risks, including the sequence of return risk, superannuation, right, running out of money before the end of your life, and then also inflation risk and interest rate risk. So there can be some benefits in some cases, but again, not nearly as popular as it has been in the past when people look to annuities. So there's a lot more, obviously, we could go into from an annuity standpoint. We'll probably leave that to another webinar that we focus just on the pros and cons of annuities. But feel free to reach out to us. We're happy to go through the pros and cons there. And if you have an annuity that you want to look at, we do this all the time. You can send us what's called the contract package. We can review it, make sure it's in your best interest, and if not, help you get out of that into something else. So, because again, there are really good ones and there are not so good ones. That just comes with the industry there. Another strategy that we like to use specifically with our individual clients who are in retirement is more alternative strategies. Now, when I was talking about the asset classes, I breezed over it pretty quickly. Alternative investments are another asset class that you can use to further diversify. What's great about some of these alternative investments, and when I say alternative investments, they range from what you've probably heard the buzzwords around private investments, private equity, private credit, private real estate. Private doesn't always mean better. Oftentimes, as Chad will tell you, it often just means more fees. So if someone's trying to just sell you on private investments, be kind of wary around that. They can be beneficial in some circumstances, but other alternatives include option strategies, structured note strategies. These, like you see here, can provide a little bit more interest or income on a monthly basis, depending on the structure, as well as some protection on the downside. So you see that chart there with the blue line. That's an example of a structured investment or a structured note that can provide up to 100% protection on the downside without limiting your upside potential relative to an index. And if we're going back to annuities, these are similar strategies that annuity companies and providers, insurance companies use to protect themselves. So when you give, say, $100,000 to an annuity company, a lot of times they turn that around and invest in a structured investment, structured note, or some form of options strategy that protects them so they can guarantee you that payment, but doesn't limit their upside potential necessarily. So while they're only giving you 4, 5, 6%, they're making 7, 8, 9, 10% on that money you gave them. So there are ways where instead of going through an insurance company, you can access these types of strategies as well, just on your own. So you don't have to have the high fees when it's wrapped up into an annuity product. So if you have questions on that or want to look more into those alternative strategies, let us know. We're happy to review your situation and make sure it's appropriate for you. You always want to make sure you're talking with a fiduciary, obviously, who has your best interest at heart when looking at some of these investments that can come with a little bit higher fees. So again, as we always remind you, we're here as a resource for you. We're happy to help with any questions around your financial plan or your investment strategy. Scan that QR code there if you want us to review your investments. We're happy to pull up the statements that you have, go through the individual investments, help make sure you're understanding A, what you're invested in and what you're paying for, and see if there are any better options for you there. We're happy to go through that. I have the same QR code on the next page here. But if you have any questions, things that we didn't go through today, that's my direct email. You're welcome to reach out directly to myself or Chad on here as well. And I'm excited about the upcoming webinars that we have for next month. We're actually doing a collaboration with the GBS Wellness team to touch on finances and mental health. So I'll be presenting on November 5th, and then we have a mental health expert who's going to come in on the 12th and talk more about the mental health side around our finances. So keep an eye out for that. That should be a fascinating couple of presentations there. We're excited for that. And then December 3rd, budgeting and financial goal setting, and keep an eye out for our 2026 calendar. We're in the process of creating that, figuring out our topics for next year. So if you have any ideas or suggestions on what you would like us to cover in some of our upcoming webinars, feel free to reach out to us. We're always happy to take some of that feedback and incorporate that into these presentations. So that's all I had. I'm happy to answer any questions that we got through the chat.
Thanks, Rocky. As Rocky said, I'm a partner of his on the team, so I'm here to help. If anything, anyone questions anybody has. Rocky, my Zoom crashed during the middle, and there was questions in there, and now I'm not seeing any. So if you are able to pull up yours and see any, that'd be
Yep.
great because I want to make sure I get them answered. I was able to answer a couple of them. I know one that I can ask you was around target date funds. When you go into retirement, what date does that switch to, and how does that work?
Great question. And the target date funds differ a little bit based on the fund manager. So if you go into your retirement account, you may see anything from American Funds to Nuveen, BlackRock, Fidelity, Vanguard. A lot of different fund managers have a slightly different process on how they structure that glide path. And so it kind of depends on the fund manager, but most of them will have a target date around when you're turning age 65. And then the allocation will switch from that 90% stocks, 10% bonds to either 60% stocks and 40% bonds at the most aggressive target date fund to 40% stocks and 60% bonds with the less aggressive target date funds. So it's important to look at what type of glide path you have because that's a big difference, right? 60-40 is very different than a 40-60 asset allocation when you're at retirement. And in most cases, I would probably recommend more of a 60-40, depending on your circumstances, of course, so that your investments can grow for the duration of your retirement.
That's an excellent way of putting it. I will add on there uh, that the fund companies that run those target date funds, they do it based on averages. They assume that everyone's the same, everyone is average. And to Rocky's point, that's how it'll transition to as an asset allocation. Um, but if you need income in retirement, those funds are not going to, and you need more income to survive, those funds, you can't just tweak the income on them. They're going to stay the same the way that you've had them. So it, get with us. I personally believe, especially going into retirement, that being in a target date fund is not the best option for a majority of people. All right, Rocky, quick question. If I'm 45, should I be aggressive or passive, or should I be moving from aggressive to passive?
Great question. And I would say that that comes down to your goal of when you're going to need to access the money, right? If you're retiring at 50, then yes, you should definitely look to be more conservative and maybe even a little bit more in terms instead of passive, more active in terms of structuring the portfolio. But if your plan is to retire at 65, that's still a 20-year window, which again, 95% of the time, stocks are going to be up over a 10-year period. And so 20 years is still a good window to stay aggressive. Usually a passive index fund can be great in most cases. So I would say stay aggressive unless you're planning to retire or use those funds a little bit sooner than average.
Great answer. I would also add there, Rocky, that um, active managers often get treated poorly because of what we hear in the news. But they do serve a purpose. And as long as you are monitoring the fees and keep them reasonable and monitor the manager and that they actually earn their keep, you can still stay aggressive without taking on the full risk and volatility of an index fund, which index funds have, and S&P 500 in particular, has done great for 15 years. But if those of us that were investing in February, you experienced a pretty big drawdown when tech stocks sold off. So um, that answers that question. Another question here involves how you model pensions and account for the growing payout as years of service increases in retirement years.
Yes, that's a great question. And I see, Chad, you probably didn't see this one. It was from earlier. Ties right in with that with pensions as well. We do treat pensions typically as a bond in our allocation strategies because those are guaranteed very safe, right? And so they do cover more of the bond allocation. So you can afford to be a little more aggressive if you have a pension from your employer. And we do have models that can kind of model that growth in the pension depending on years of service and how much you're making. Um, so let me make sure that answers that question. Yes, because as you work more, that pension will typically grow, and so the more aggressive you can be with those other retirement accounts, those investment accounts, because you have that base, so to speak. And a lot of people will have Social Security as well that can account for that base. And depending on your expenses, you may be able to be more aggressive with your investments if you have a higher Social Security base relative to your expenses.
Okay, thanks, Rocky. I wanted to kind of sum up here with a few of my comments. I've been doing this about 20 years, and the one thing I can say is that, to Rocky's point earlier, target date funds are designed to be mediocre.
Mm.
Investing is not as easy as we've been led on to believe that it is. The last 15 or so years that we've all experienced have been an unusually calm period of time in the markets. And it's more or less how you behave when the markets are not going up and to the right in a straight line is what's most important when it comes to investing, is to control your emotions. It's not necessarily about picking the best investment. It's just about staying invested. And if that's something that you struggle with, or you're looking for ways to pick different investments that may keep you invested but are less volatile, reach out to us and we can help provide some guidance around that. It can be within your 401k plan. We're not going to try to tell you to move your money to us so we can invest it for you. We just want to make sure you get help, although that is something that we do. But we do want you to get the help that you need. It's a complicated business. I feel like my industry intentionally makes things difficult, and we're here to help make that easy for you. So if any of you out there are wondering, what am I invested in? Is it what I should be invested in? Or are still confused or have questions, there's no such thing as a dumb question, particularly when it comes to this. I like to tell people, you don't want me behind a pharmacy counter slinging out pills, because I promise you it's not going to go good for people. We all have the things that we're good at, and this is what Rocky and I are good at. So please, please, please reach out if you have questions.
Yeah, absolutely. Thank you, Chad.
Thank you. Yeah, I was gonna say, Rocky, you can go ahead and close this out, and if you'd like.
Absolutely. Yep. So thank you everyone for joining us today. Keep an eye out for the follow-up email tomorrow with the recording. There'll also be a survey in there. We appreciate any feedback that we receive. Also include any expected or hopeful topics that you'd like us to go over. And then, like Chad said, reach out if you have questions, and I hope you all have a good rest of your afternoon.